Hello, this is a continuation of previous session risk and return, where we discussed about the estimation of return for different securities, expected as well as historical rate of return. Then we talked about the risk involved in the investment in securities as such and different factors that contribute to risk, and how do we measure the risk in terms of standard deviation, range, variance and all those measures. This is a continuation of the previous lecture. In this we are going to talk about the concept of required rate of return, what are the factors that affect, as well as we are going to talk about the portfolio risk and return. When we say portfolio, it is a combination of different financial assets, and in this portfolio risk or return depends upon obviously the individual asset that is comprising of the portfolio comprises of. So, coming to the first one, that is concept of required rate of return. It is nothing but the rate of return expected by the investor from an investment, and the factors that affect the required rate of return could be, we have the time value of money. Time value of money is something, a simple principle. When we say that today's 1 rupee is not same as tomorrow's 1 rupee. If somebody is investing some x rupees today, obviously he will be expecting something more tomorrow. It is because if he is investing in an asset today, he is just deferring the consumption of his whatever he wants to consume today, he is going deferring to tomorrow. So, for that he needs a reward, and in that case he should be getting that much money where he can consume little more than what he is sacrificing today. So, because of that you have a time value of money is one of the basic fundamental principle in a investment scenario, because we invest today to get something back in future. So, there is a time gap, and people will like to have a reward for waiting or withholding consumption with the resources that they have contributed to by an investment. Next thing that we have is the expected rate of inflation. Besides the change in preference, change in consumption, deferring the consumption to future, we also have something like expected rate of inflation. That means, if today I am able to buy 10 units of products with 100 rupees of currency, and tomorrow I may not be able to buy the same 10 units of product, I may be able to buy maybe 9 or 8 units of product, because there could be a change in the price level of the product that I am buying. So, in that case there is an inflation that is going to take place. So, that inflation also will be affecting the required rate of return. If the expected inflation is going to be 5%, the required return could be x. If it is going to be more than 5%, the inflation is going to be more than 5%, then required rate of return is going to be more than that. So, in that case inflation is one thing which has to be captured as a factor of affecting the required rate of return. Then we have the risk involved. Risk, as we discussed previously. So, if there is a high risk involved, and then obviously I will expect more risk rate of return. If the low risk involved, I will have more rate of I will have to expect more rate of return, and when it there is no risk involved, there is no uncertainty when about what I am going to get back from the investment. In that case, my required rate of return will be equal to the time, will be only taking care of my time value of money as well as the rate of inflation in the economy or what are the sector for that matter. So, risk involved, as we discussed previously, risk involved could be of different types, and like business risk, financial risk, country risk, exchange rate risk. Before we go further, we may go to another concept called the real risk free rate of return, that is called RRFR. The real risk free rate of return is the thing where we say there is no inflation. That means, if there is going to 7% inflation and there is a rate of return is, let us say expected is 12%, that means real could be 12 minus 7 in a 5 in a very simpler term, but the formula is not that simpler as such, a little bit complex little. And in the real risk return, real risk free rate, what we assume is there is no uncertainty about future cash flow, there is no inflation, and we do not say that there is going to be any fluctuation in what we are going to get. And when we say future cash flow, if it in the case of a debenture or bond, the future cash flow is determined in terms of the interest received, and then we also get something back in terms of principal. So, there is no uncertainty as well in terms of interest to be received as well as in terms of the principal I am going to get back. So, there is similarly in equity share, I do not have any uncertainty about getting something dividend. I also do not have any uncertainty about getting some change in the market price. So, if that is not there, then we say there is no uncertainty, and then only the inflation is not captured also. So, in that case the real risk free rate of return is defined by the where there is no inflation and there is no uncertainty about the future cash flow. Then also it is also only influenced by the time preference for consumption of income and investment opportunities in the economy. So, I will withhold the consumption till tomorrow. So, only for that I would like to have some reward. I do not bother to inflation because inflation is absolutely 0 in this case. I do not bother about this change in the price level. I do not bother about the future cash flow is going to come because that is going to come all of a certainty. So, only thing that I am going to capture in my expected rate of return, which is my risk free also, is the only that I am withholding my consumption till tomorrow. So, depending on the economic condition, I am expecting something going to better happen, then in that case I can expect that I will consume tomorrow. So, I can invest today. So, to whatever is return I am expected to reward that phenomena, that is called my real risk free rate. And there is simpler formula here, where we say real RFR is nothing but 1 plus in the numerator you have 1 plus nominal RFR and then you have got 1 plus rate of inflation. That means, if we have nominal RFR is let us say 0.12 and the rate of inflation is 0.05 or that is called 5%, then my real RFR will be solved like this. It will be 1 plus 0.12 divided by 1 plus 0.05 minus 1. So, that is nothing but 1.12 divided by 1.05 minus 1. So, this is the way one can get the real rate of return, which will be obviously between something between 5 and 12% if you calculate further. Then similarly, we can also find out what is the nominal risk free rate return, which will depend upon the condition in the capital market. That means, if the condition in the capital market is going to be good, then in that case I am going to have more I will expect little more rate of return because the condition is good and because the economy is going to invest in good assets and the assets are going to give you good return in future. So, for that matter I will expect a higher rate of return as such. Then we have one more thing, that is expected rate of inflation. So, if the inflation is going to be higher, then I will expect more rate of return in a nominal form. And next thing, that if you look at if you change the formula, then 1 plus real RFR into 1 plus expected inflation minus 1 gives this one. So, coming back to this particular point, if you get this as x, if you calculate, that means we can go to nominal RFR by applying the formula, that is 1 plus x into 1.05 minus 1. So, the same formula has been derived out of the previous formula here, and the nominal is nothing but, so that means you have the real rate of return expected and you one has the also the inflation rate, multiply that and minus 1, whatever that we get, that is called the real the nominal rate of risk free rate of return. Obviously, in this case it is going to be 0.12 because we have used the same input which is used in the previous example. Then next thing is that what is the risk that is affecting, it is a continuation of the previous class also. What is the risk that is there which will be affecting the business? So, one is called the business risk. Business risk means the company whatever assets they have put, where the revenue coming from, which type of sector they are operating in. So, and what is the cost structure of the particular company? The cost structure of the company is more in terms of fixed cost and less in terms of variable cost, then they will have to go for a higher production and sales level, so that they can recover and they can have break even point, they can think of having some profit. So, the risk is obviously going to be higher if the company is relatively having high fixed cost. So, this is something also known as operating risk, and similarly the company might have gone to different business as such. So, that is also going to affect the business risk of the company. So, if the investor feels that the business risk is higher in this company, so obviously in that case the expected return which captures the risk in that will be higher. Then next thing that we have, is the financial risk. Financial risk is comprising of the fact that the company has borrowed money and investing. So, if there is any profit, any cash flow, before we take care of other operating expenses, we have to take care of the interest obligation and also we have to take care of the principal repayment. So, there is a claim of the creditors over that, and even is a bad condition or good condition, and if there is a profit making or loss making, whether you have surplus or not, interest has to be paid. So, in a very bad condition, interest has to be paid. In that case, the return that is available for the cash flow available for equity investors becomes very less. Similarly, if there is a good condition in the market, good sales is taking place for this company, the target company, in that case obviously the company is not going to pay more interest because the company is doing well. Company will pay the same committed rate of interest, could be 10%, 12%, whatever on the date that the company has taken from the market or from the financial institution. So, in whatever the interest is something like a fixed obligation which has to be honored irrespective of the circumstance. So, high debt will lead to high interest. High debt in relation to equity is going to be more riskier than any other company which has got less debt to equity. So, the company that I am investing, if they have got more exposure debt in relation to the equity, that company is going to be riskier than the rest of the company, the industry as such. So, that is called financial risk. Next that we have is called liquidity risk. Liquidity risk is something where we have a doubt that whether what I have invested today in the market, can I get it out, of or not, out of the same or not. Because a typical concept of market, or the best concept of market could be that when one of the best conditions of the market is that you should have an easy entry and easy exit option. It should not be that I invest in a particular security and then I like to come out of that for whatever reason and there is no avenue for me to come out. That means, possibly there is no buyer of that particular security, or I do not know where to go and sell the security so that I can get back my money. So, that is one. Similarly, if I have missed to invest when the company issued this particular security, now I feel that particular investment is attractive for me, I should have an option to invest in that particular security. So, I can do that in one case the company issues additionally those securities in future course of time, but I need not wait for that. If that particular investment is sold by the existing investor, the investment holder, in that case I can also buy. So, this is something called the provision of liquidity in the market, where you can buy and sell the shares or bonds, debenture or whatever financial asset that you are holding. So, you should not have to wait for some more time to find out who can buy the share. So, if I feel that what I have invested there is a problem in liquidating that particular investment to cash, transferred to someone else, there is no ready made market for that, then obviously I am thinking there is a risk involved as per liquidity is concerned. So, stock exchanges or any exchange, financial exchanges, who is going to facilitate this particular function, that is when you are going to buy and sell this security. So, if you have already bought this security, you can as well sell it and get the cash back. If you have not got it, you can as well buy that security from the secondary market. So, that is what the liquidity is. So, I am presuming, the investors presume that liquidity is there or not there, accordingly the risk has to be incorporated. Then we have got something called exchange rate risk. Exchange rate risk could be one way that the company is investing into certain assets, certain raw material they are consuming, which may depend upon the forex rate, because they are importing such items. Another exchange rate risk could be that company's sales itself takes place outside, though they are sourcing and producing everything in the domestic market, but they are selling most of the items in the foreign market. So, in that case obviously the realization from the sales will depend upon the change in the forex rate, dollar to rupee or pound sterling to rupee or euro to rupee, that rate will going to affect the sales level. The quantity may remain same, but the value of the sales may go up or decline because of the change in the forex rate. Another exchange rate is that is risk is that as an investor I may like to invest in a company which is in Japan or Europe or US or Canada for that matter. So, in that case my investment return and everything will depend upon the forex rate condition, foreign exchange rate condition between the country where I am investing and the country which I belong to. So, that is also going to be there. So, the exchange rate risk is also going to be captured as a part of risk, and if the exchange rate risk is perceived by the investor, then obviously the return expected by the investor is going to be more. Coming to next one, that we have got something called country risk. So, beside the fluctuation in forex rate, the country that I am going to invest, even if the both the countries where I can exchange my, I can buy the asset in a particular currency in both the countries, but still one country may be more riskier to invest than other country because of the political and economic condition in that. If there is some political unrest in that particular country, the democratic setup is not that well functioning. In that case, and there is no proper legal law and all mechanism where you can resolve your disputes and everything. So, if such things, the governing condition is not good in that country, obviously that country is going to be high risk than the other country where these conditions are well set and you do have a good mechanism of governance as well as redressing your the disputes and whatever. So, in that case the country risk is going to be lower. So, I am also going to capture, the investor is also going to capture the country risk as a part of risk when the investor is investing in a particular security, particularly when the security is that belongs to a company which is established and operating in another outside country as such. So, these are the different risks that is there in the market, and so the risk premium becomes essentially a function of business risk, financial risk, liquidity risk, exchange rate risk, country risk, and all these risks which is there, the conditions risk is there, these risks are typically market specific risk. So, business risk, but for the risk involved in the cost structure of the company, and these are the risks which somebody cannot mitigate on its own. So, it is something like a market risk which is called systematic market risk. Systematic market risk means the risk that is involved in investing a particular asset which cannot be diversified by investing another security. So, these risks are going to continue whether I change the investment from X to Y or Y to Z for that matter. So, this is called systematic market risk which you cannot diversify. What you can diversify only on systematic risk which is unique to the particular company where I am investing. So, the risk premium depends upon the systematic risk of the or the market risk for that matter. Now, having discussed the risk premium as such, there is a relationship between risk premium and the portfolio theory. Portfolio theory in detail we will be discussing in a subsequent classes on the when you talking about portfolio theory. But typically when you say portfolio, portfolio is nothing but the a combination of financial assets the particular investor is owning or investing in. So, in that coming to that, the relevant risk measure of an individual asset is the co-movement of the market portfolio. So, when you talk about portfolio in theory context, what you say here is that whatever when you talk about individual asset, how this particular asset is moving with another the market assets. So, moving with the market means if the market is going up, then this particular security is also going up. The market gives a positive return, this security also gives a positive return. Market gives a negative return, this security also gives a negative return. So, it may be so that is the particular security is moving in tandem with the market asset, but there may be some security which may move against the market. Against means the market is actually upward and this particular stock is actually moving downward. So, there is a expected fall in the market represented by the index like a Sensex or Nifty or Nasdaq index, S&P index. So, I will like to buy the share of that company which is going to actually move upward direction when the market is down. So, that is called, that is moving in opposite direction the market. So, any share can move in either opposite direction or in the same direction the market, or may not follow a particular path like this direct or indirect path, it may follow its own path. So, this measure that we are talking about is the how the particular stock is moving along with the market portfolio. Market portfolio is typically comprising of the, ideally market portfolio should comprise of all the assets, all the financial assets traded in the market, whereas, but it is not possible to find out the portfolio of the assets of all the investments in the market as such, and because some of the investments may not be traded, may not be totally liquid, highly illiquid for that matter. So, you do not get the proper price return statistics on those. So, we rather go for a representative market portfolio, that is could be an index. So, best example of index could be one of these BSE Sensex or Nasdaq index or a Standard & Poor's index, or we have a CNX Nifty in Indian context. So, these are the index which comprises of something 50 stocks as in case of Nifty, 30 stocks in the case of Sensex. So, 30 or 50 shares that is comprising that is the index comprise of they are supposed to represent the broad market. So, the Sensex or Nifty for that matter represent the market portfolio, they are not necessarily market portfolio as such. So, we have to see how this particular stock is moving, how this along with the market portfolio. And then as we discussed, it is a the risk involved with the market is called systematic risk. This risk relates to the variance of the investment to the variance of the market. So, how much it is varying with respect to the market. So, that is called the systematic risk, which will be there, which we cannot avoid, because this is going to be there as long as you are investing in the market as well. So, all the investments will be, all the shares, all the financial assets are likely to move with the market, and market's movement is the variance is known as variance there. So, how this, what is the relation the variance of the investment to the variance of the market is the systematic risk. So, some of the investments may not move in the same proportion of the market, it may move in same positive direction, but not necessarily equally proportionately with the market as such. Then the return that we, the systematic risk that we actually call, we measure in terms something called a beta. Actually, when you say beta, it is nothing but the regression coefficient of the returns on security on returns on market. That means, if we have a series of returns on security called I, then we have a series of return on security called M, on the market portfolio, then we have got something called a date here. So, there are different dates, and different dates the holding period return could be something like this, and there will be some returns whatever 10%, 12%, 5%, whatever that may be. Now, when you run a regression of this RI, that is called dependent variable, on the return of market, that is called RM. So, that whatever slope you get, that is called the beta as such, a simple regression coefficient. So, if you can keep in a simple format. So, we have got alpha plus beta RM plus, in a popular term we have got error term. So, this beta what you are going to get is nothing but running the regression of this return on the security called ith security, which is also known as a dependent variable, and this return on the security I depends on the market return, that is called the independent variable. So, we are saying the security return depends on the market return, and whatever slope you get here, this is beta, that is called beta. So, the beta is high, obviously it is supposed to be more risky, beta is less, it is supposed to be less risky. So, interpreting beta as such, if the beta is found to be 0.80, it implicates that if there is 1% change, could be upward or could be downward in market, that means the market goes up by 1% or market comes down by 1%, then there will be 1% change in the market, then it is going to lead to 0.8% change in the ith stock price. Similarly, the beta is 1.2, so 1% change in market will lead to 1.2% change. That means, when we say 1.2% change, if there is a fall of 1%, it will be coming down by 1.2%. In a 0.8% case, if there is a 1% change in the market, the rise could be up to this and the fall could be up to this. So, this difference between these 2 points, 0.8% here, 0.8% here, obviously is lower than the difference between these 2 points. So, when you say change, change can be upward, change can be downward, and there is a variance you can see, it can go down by 1.2%, it can go up by 1.2%. So, obviously, looking at that, higher the beta, we say higher the risk. So, the particular stock which has got more high beta, so we say higher the risk involved in this particular asset or financial asset for that matter. So, this is the simpler interpretation of beta, which is representing the systematic risk of the company, the investment, which is actually affected by the market risk of the market risk involved in investing that particular stock. Then, as we already we have told about that, there is something called fundamental risk versus systematic risk. fundamental risk comprise of business risk, financial risk, liquidity risk, exchange rate risk and countries, all those things are there. Whereas, systematic risk is something which is the portion of an individual asset's total variance attributable to the total variable to the total market. If the risk is x percent, but how much is affected by the market and how much is affected by the individual stock itself. So, this is called the systematic risk. There is a very simpler measure also, where we have a concept called coefficient of determination, which is known as the square of correlation coefficient, is the correlation coefficient known as R, then R square gives a coefficient of determination. Now, if correlation coefficient is 0.7, so R square becomes 0.49. So, that says 49% of the risk is affected by the market. When you say correlation, when you say the correlation is between the, so the R is between the correlation coefficient, it is between the stock return and market return, and we know the market return is dependent and stock return is independent. So, the market return is going to affect the stock return. So, 49% of the risk involved in the stock is affected by the market, which is actually the independent variable. This is another way one can find out the system. So, systematic risk portion is 49% and unsystematic risk is obviously 51%, that is nothing but 100 minus 49%. So, this is the unsystematic risk. So, this 49% is market risk which cannot be diversified. So, you can diversify to the extent of 51%. Then there is this particular graph shows the risk free rate of return, the nominal risk free return on the x axis, and the business risk, that is our systematic risk, which is measured by beta, is on the y axis. So, sorry, the RFR is on the y axis, whereas the business risk and systematic risk or beta is on the x axis. So, if the business risk of the particular asset is going up, so that means if it is moving from 0 to 1, 2, 3 like on the x axis. So, depends on the more is the risk. So, it will be high, low or average, and high, low and average. So, low risk means the beta is high, low risk means beta is low, that is lesser, average means little more, high risk is little further more. And this particular when you plot these different stocks or different investments on this line, this particular line is called security market line. It is nothing but the on the x axis we have risk measured by the beta of the particular stock, and beta is measured as we discussed earlier, and on the y axis we have the rate of return, that is expected. So, we start with something like risk free return, that is the graph starts from the RFR. When the business risk is 0, then in that case we are going to have this much minimum rate of return, and as the risk of the particular asset goes up, so the return expected on the investment in different assets go up. So, highest risk is obviously going to have highest possible rate of return. Then what happens in the market? So, changes in the required rate of return due to movements along the security market line. So, if there is I feel the investor feels that the investment is going to have a less risk as such. So, in that case what will happen, if we had an SML as in the graph that is shown in the SML like this, then at this point of time I feel this is the risk involved as per the investor, this is the risk and this is the required, that is the return expected by the investor. So, if this is the risk I am feeling, obviously this is the amount of return I expect, that is nothing but this particular return. But if I feel that the risk of the particular investment in this particular asset has moved down, let us say from this point to this point. So, in that case that means risk is actually moving down from this point to this point, then my return that I am expecting will be now this much. So, in the SML, as I move upwards, so my return is going to be higher, as I move downwards, my return is going to be less. Moving upwards means I am having higher risk. So, it is not necessary that for every time to come the risk involved in a particular asset is going to be constant, rather it can go down or it can also go up. If it goes up to this particular point, then my return will be little that I have expected written R 2 it will be little more, because the risk involved in this particular asset actually has gone up. So, that is the change in the position of a particular stock's return in a particular SML. So, this is a movement from high risk to little lower and further little lower to further little lower risk involved in that. Next, in fact, we estimate like this, where you say risk premium is nothing but expected rate of return minus the nominal rate risk free rate of return. So, this is the difference as such risk premium, and so change in the slope can also be. So, slope means I have a presently the SML is like this. So, this is my slope, this relation between this and this gives the slope, but that means for every additional unit of risk I expect a particular amount of return, but the slope itself may go up. So, in that case the line will change. So, the slope is going to be higher. That means, at this point of time the investor is expecting a reward for any unit of risk involved is a little more reward than what he was expecting earlier. So, the slope of the line is changing. Now, possibly in depending on the market condition, I may expect little much more risk, little more return than this particular graph, where my slope is actually higher. So, in that case I am expecting more return on the investment depending on the risk involved. Earlier, if I was expecting let us say 1% extra per unit of risk involved, now I may expect 1.2. So, the beta might have gone up from one stage to another stage. So, in that case it will be going to be more as such. So, the market risk premium for the portfolio can also be found out. So, where you say that the market portfolio risk return as such is nothing but expected return and minus the nominal risk free rate of return. That means, if my expected rate of return is 18%, that is on the portfolio, then if the nominal risk free rate of return is let us say 8%, that means the risk premium on the market I am taking is how much, is called 10%. So, this is nothing different than any individual asset also. Instead of talking about individual asset, you are talking about a combination of the financial assets called the portfolio. So, the risk premium measurement is the almost same as what you do in an individual asset as well as in the portfolio of assets. So, this is one place where we have got this SML changing from one place to another, that as we discussed in the graph. So, there is a what is happening here, whatever return they are expecting for risk involved has actually that per unit per into risk that return is expected is actually going up. That is why the SML has moved from one stage to another stage. In some other case also the SML can come down. So, here you have a SML like this. Since I am expecting that my expectation is something that my return I expect from the risk involved has come down. So, the SML in this case what will happen, if I am my asset's return comes at this particular point of time, and if I am expecting that reward per risk is going to come down, my expectation is like that, then the slope of the particular graph will be lower. Now, I will be expecting this much return for the same type of asset, but I am going to expect race return, and this is called the risk free rate of return. So, I will be expecting this much extra. Earlier I was expecting this much extra, though the asset class has not changed, it has remained this same, but since the return I expect the reward for the risk involved is lower, that is why my return expected from this asset has now come down from here, maybe it was 12% and it is could have become now 10%. So, this is the way this is the original security market line and this is my new security market line. Here we talked about original SML, then we had new SML1 and new SML 2 where the return expected for unit of risk involved has actually gone up from one stage to another stage to another stage. Then overall in the market itself, the expected return from the in the market may go up because there is a change in the risk free rate of return. So, earlier I was expecting an inflation of 5%. So, in that keep factoring that my risk free rate of return was let us say 8%. For whatever reason the inflation has either gone up or gone down, let us say inflation has become now 7%. So, quite naturally my RFR will now move up from 8% to at least 10%. If you have to have a simple addition of 2% difference between this inflation earlier and inflation now, then 2% plus 8% becomes now 10%. In that case, the graph which you had started, the SML which had started, the old SML which had started at this point, since the RFR itself is changing, it becoming this one, then graph will just move upward without any change in the slope of the graph. So, this becomes a new SML. Now, if I had a class of asset like A, I had a class of asset like B and I had a class of asset called C. If I was expecting here, I was expecting let us say 9%, here I was expecting let us say 11%, here I was expecting actually 13%, these are the percentage here. Then since this RFR itself has gone up from 8% to 10%. So, obviously, this 9 will now become 11% and this 11 will become now 13% and 13 will become now 15. So, there is a upward parallel shift in the SML from old to the new. Similarly, I expect the risk involved in the total overall market is going to be now lower, then in that case my RFR itself may come down from 8% to let us say 6% because of change in inflation, lower inflation, whatever that may be. In that case, I will have a new SML which will start from the RFR of 6% and which will be parallel to the old one. So, what we are saying here, we are assuming that the per unit risk, whatever return I am going to get is not going to change, rather the base of risk return has changed. So, the overall SML itself has either gone up, moved up, or it has gone down depending on the RFR condition. Now, we go to the next part of this particular class where you talk about how do we measure the portfolio return and portfolio risk. Earlier class we have already discussed the portfolio return, but we can also repeat that now. So, the return on a portfolio depends upon the weights involved in the assets that we have and the individual return. So, if you have got two assets called asset called A and asset called B, and if we are going to have 14% return from asset A and 16% return on asset B, and if your weight is involved is let us say 0.50, 0.50 in both the assets, asset called A and asset called B, that is the weight of investment. And if we are expecting return on asset called A as 14% and asset called B as let us say 16%. So, the return on the portfolio is the return on the asset called ith asset called A or B. So, return on portfolio will be now 0.50 into 14% plus 0.50 into 16%. So, that gives us 7% plus 8%, that is gives you 15% return on the portfolio, between 14 and 16% now. So, if the weights change from 50-50 to 40-60, so accordingly portfolio return is also going to change. So, this is only a two asset scenario. You can have n number of assets, and obviously for n number of assets we need to have the weights of the different assets as well as the return expected from the different assets as such. So, we can look at another example where we have got 4 assets where we have got 20% asset, 20% of investment is in A, 30% of investment in the asset B and 40 in C and 10% in the asset called D. and the expected from the each asset is like this, that means 18%, 16%, 20 and 24. Applying the same formula, you multiply 0.20 20% into 0.18, accordingly like that for asset D we multiply 0.10 and 0.24. So, overall that you will get is 15.8%. That means, in an extreme case, if I had put money 100% in the asset called C, and then in that case I would have got 20%. Had I put 100% in asset called B, I would have got 16%, that is the lowest return, and the C is giving the highest return. But instead of that, because I may feel that asset called C may actually go up or come down, it may be more risk involved. So, to diversify, to have a minimum return as such, some is assured rate of return, then instead of putting money all money into one asset called C, I now put money into 4 different assets, and that expected return is combination of that is called 15.8% is the return expected from the portfolio. It is this very simple principle that we say, do not put all eggs in one basket, rather you keep different eggs in different baskets. So, the one basket is lost, at least some of the eggs are still left, which you can be consumed by the consumer. Otherwise, all the, if you are putting in one particular asset, all your money 100% money is may go up like anything if the market is moving up, it may also can also come down if the market is down. So, in that case we rather diversify our portfolio by investing in different assets. Next thing that we have is called the portfolio risk. Portfolio risk nothing but the variance involved in the portfolio. So, if one is able to find out the variance in the individual asset, then one can also find out the variance in the portfolio. Now, if I have got in the earlier case, when you have got return on different condition, condition 1, condition 2, condition 3 and condition 4. It could be the best economic condition, this could be very good condition, this could be an average condition, this could be poor condition. So, for a particular stock, if you are expecting let us say 12% in the best condition, then 10% in the little worse condition, then 8% and then 6%. These are the condition. For that, we also should have the probability associated with this particular event condition 1 to condition 4. So, you have let us say 20.25, 0.30, 0.40 and the rest is 0.05. So, what you do? We multiply like this. So, 0.25 into 12, 0.30 into, so this total is actually 1.00, 0.30 into 10%, 0.40 into 8% and 0.05 into 6%. So, what we get here is that 12.225 that gives 0.03, this also gives 0.03, then we got 0.032 and then we have got 0.030. So, see total of this gives you as 2 and so 0.122, that is 12.2% is the return from the asset expected return depending on 4 different conditions. So, like that we do here, we can also do the same thing for a portfolio. So, what you would do here is that this 12% or 10% whatever that you have expected from the return in the stock, we have to now measure that from the portfolio and this particular 12% in the return on a portfolio, it will depend upon obviously as you discussed earlier, it will be W1 into R1 plus W2 into R2 like that, we have got Wn into Rn. So, whatever you get, we now get Rp under condition 1, similar condition 2, condition 3, condition 4, whatever return you will get and then multiply the respective probability, then you will get return on the portfolio. So, in the risk calculation what you do, we take the difference between the return equal 12% and the average return and square it and then we multiply with the respective. So, what we do here, we say 0.12 minus 0.122 in the first case and we square it and multiply the respective probability, in this case 0.25, like that you do, and when you add that summation, that gives actually variance or sigma square and you take the square root of the variance, that gives us the standard deviation, that is called the variance square root. So, same principle is applied as far as the return, as per the risk of the portfolio is concerned. So, what you do here, assuming that this is the portfolio return, average return, and these are the different returns on different circumstances in the portfolio. So, in that case 12.2% is the average return, and we can find out the variance in the same measure, that same way that we did in the previous session as far as the risk in this individual asset is concerned. This is one way, and another way that we have is that we find out the movement in the assets, how they move with each other and how they move along the market, and based on that also one can find out the portfolios. Instead of doing a weighted return of the portfolio and finding in this way, you can also find out another which we will be discussing subsequent slide. So, risk of the portfolio actually depends on the risk of the individual asset of the portfolio and the covariance of returns of assets in the portfolio. That means, if the there are assets in a portfolio like A, B, C and D. The risk of the portfolio which comprises of these 4 assets will depend upon the risk of individual assets like A, B, C and D, and how they move with each other, how A moves along with B, how B allows to move A, how A moves along with C and how C moves along with A, and how A moves along with the D and D moves along with the A. Similarly, what is the how is the D and C are related, then how C and B are related, and how D and B are related, and how C and I are related. That means, as many pairs that can be possible for the relationship. So, this movement is also going to affect the risk of the portfolio. So, it is not only the risk involved in A, B, C or D, rather how they move with each other, that is also going to affect the risk, and the moving with each other is called the covariance. So, covariance could be there could be covariance between A, B, covariance between B and C, C and A, B and D, C and D, like that, as many pairs as possible, that is covariance. So, all this covariance as well as variance of individual stock like standard A, standard B, standard deviation C and standard deviation D, all these things are going to affect the variance of particular portfolio. So, one should not take that variance of portfolio is simply the average of the variance of individual assets in that portfolio. Individual assets of the portfolio affect the portfolio variance as well as the how the individual security are varying with each other, that is also going to affect. That means, if one asset is going upward, another asset is going to downward. So, that means, the risk involved in one asset is compensated by the risk in another asset as such. So, any gain in asset A is now neutralized by a loss in asset B, or another way you can say a loss in asset B is now neutralized by a gain in asset A. So, that case the risk is going to be reduced. So, risk of the portfolio is expected to be reduced with inclusion of more assets in the portfolio, but there is also, it is not necessary that you have to can increase the portfolio size in terms of number of assets to as many numbers of assets. There could be a limit, optimal limit up to there is 30-40 stocks. If we can have, then the portfolio can be taken as a well diversified portfolio. In a 2 asset portfolio, the return on one asset is negatively correlated, the portfolio risk is going to be lower when the returns of assets are positively correlated. That means, if we have to club make a graph, this is the price of an asset, and let me go back to this graph once more again. This is the timeline of an asset, and this is the price of the asset, the timeline of the investment. So, if you have an asset called A which is moving like this, and you have also an asset B which is also moving like this, almost parallel to asset B, then there will not be any reduction, the diversification. If you are having 100% A and now you are having 50% and 50% B in asset composition, in that case the risk is not going to reduce, because the B is moving in tandem with my A assets. But that means, there is a rise here, there is also rise, there is a fall, there is also fall here. So, they are not neutralizing each other. That means, obviously one can find out there is a positive correlation, and very high possible correlation could be 1 here. But if you are a scenario asset A is moving like this, whereas asset B is moving like this, in that case, if there is a upward movement in asset A, there is a downward movement in asset B. So, they neutralize each other. So, the overall return may fall in line between these two, and obviously, in this case the fluctuation is not to be seen, and there is no fluctuation in investment portfolio of A and B, that means the portfolio risk is actually reduced. So, if you can have two assets which are perfectly negatively correlated, then the risk can be reduced to the maximum extent. So, positive correlation between stocks will lead to less less divergence in the risk as such than high positive correlation between stock returns. So, as you suggested earlier, there is an alternate measure of risk here. What happens here, as you discussed again, the portfolio risk depends upon the individual risk, that is the standard deviation of the ith asset, weight involved in that particular asset, as well as the covariance between the ith asset and jth asset. I can go from 1 to n, j can also go from 1 to n. And so, portfolio is standard deviation in the portfolio where the weights are assigned as per the combination of asset, and the variance returns is given as an asset I. Then we have the covariance, that means we need to have the covariance between two asset return, we also should have the variance of the one asset return in the individual asset in the portfolio. Then if you look at this particular example, we have the asset are asset called A and B, where you have got 10% return, expected return, and 20% expected return is there in asset B, and weights attached to these two stocks are 0.50 and 0.5, 50% weight is there, and the variance is 0.0049 and 0.0100. Then we go to find out the standard deviation 0.0 and 0.10. The standard deviation portfolio is nothing but what you do here, the weight square the 0.5 and 0.5, then if you go back to the graph, so the equation, we have got W1 square and standard deviation 1 square, then we will have W2 square and standard deviation 2 square. So, like that it has been done. So, this one gives us the W1 square, this one gives us the standard deviation 1 square, this one gives the W2 square. In this case both the assets have got 0.5 and 0.5 weightage. So, this got 0.20, 0.20. Then this is the relations between asset A and asset B, and this is the relation between asset B and asset A. So, in a two portfolio context, actually these one the third component of this equation and the fourth component equation is nothing but one and same. So, what happens in a equation format, the portfolio return in a two asset portfolio, it is a variance, then we have got W1 square standard deviation 1 square plus W2 square into standard deviation 2 square. Then we have got W1 standard deviation 1 and then covariance 1 2, then we have got W2 standard deviation 2, then we have got covariance 2 1. So, essentially this becomes one and same. W1 in W2 and W2 into W1, and instead of standard deviation 1 is standard deviation 2 as such. So, covariance 2 and 1, and covariance 1 and 2 is same as covariance 2 and 1. So, if you have to simplify this equation, it becomes W1 square standard deviation 1 square plus W2 square standard deviation 2 square, and since these two component becomes one and same, it becomes now 2 W1 W2 and covariance 1 and 2, and this covariance between two stocks return depends upon the correlation between stock 1 and stock 2 return and the standard deviation of 1 and standard deviation of 2. So, if somebody has the correlation between the stock return and the individual standard deviation of the returns of stock 1 and stock 2, then no need to go for a simple calculation, one can replace this with the covariance of the stock as such. So, if you go to the equation what we have done is we have taken the 0.6 the correlation coefficient and 0.6 into 0.07 0.10 gives the covariance of the between 1 and 2 or as well as 2 and 1. So, if you go further we will get a simpler Excel sheet. In this case we have taken the portfolio risk we are calculating in a 2 security portfolio. So, there is A and B and weights are 0.5 and 0.5 and standard deviation return is 0.15 and 0.12 and correlation is 0.80. So, portfolio variance by applying the formula is now 0.0164 and standard deviation 0.1282. If somebody if one there is a 0.80 means high positive correlation. If as we discussed earlier low positive correlation reduces the risk and because negative becomes much less risky as such. So, if I one change it from 0.80 let us say 0.50, now the portfolio standard deviation it changes from 0.1282 now it becomes 0.1172. If somebody makes it minus 0.5, now 0.1172 has become 0.0687. So, this is the thing what happens is that with less positive correlation the risk of the portfolio comes down, when it becomes negative the risk of the portfolio becomes much lesser. In a 3 security portfolio what we need? We need the weights involved in 3 security, we need the weights the standard deviation also of 3 security, but we need the correlation between A and B, B and C and C and A, all the composition of assets have to be there. Then accordingly the variance can also be found out with this input and we get in the 3 portfolio 3 asset portfolio where 35% A and 40% B and 25% C is there, total is 100%. The portfolio standard deviation is now 0.1369. If somebody changes this mix from any other mix to become another mix, then also the standard deviation is going to change. So, if in this case we make this point in the 2 asset portfolio make 0.6, now you make it 0.40, then the standard deviation has changed from something figure now it becomes 0.0780. Now, similarly, that means weights of the asset in the portfolio and the individual assets risk and the relation between 2 different assets return that changes that makes the portfolio risk as such. So, this is the way we covered the how to calculate the risk of the portfolio involved. Thank you.